I welcome Thomas Marlitz, Vice President, Regulatory and Compliance, BFS Finance in Germany. So, looking into our topic, non-recourse factoring is experiencing steady growth, and globally it accounts 53% already of the total factoring volume, which is significant. Years ago, we were on a different level. Now we have that major part in the factoring volume globally. So, but when we are talking about non-recourse, we are talking about del credere risk and to deal with that. So, and I'm really happy that Thomas will explain a little bit. What is the special attention in terms of risk mitigation with the trade credit insurances in your company? So maybe if you could give us an introduction what you're doing and that we are elaborating that field.
Okay, what I'm doing, I don't know. Coming from the factoring industry and talking about factoring in Germany, in the DACH market in Germany, Austria, Switzerland mainly, the non-recourse factoring is the traditional form of factoring, the so-called recourse factoring, where the seller of the receivable carries the risk of the debtor, is hardly known in Germany. We all come from a non-recourse market. And in connection with credit insurance, I think, let me quickly explain the setup in the non-recourse market. We have the traditional setup in the triangle. We have the factor, we have the seller or client, and we have the debtor. And as different from the recourse factoring, with non-recourse factoring, the factor carries the credibility, the lead risk from the debtor. So the seller kind of outsources the risk of failure with the debtor to the factor. And the factor obviously doesn't want to carry that risk by himself. He can't do that. The premium, the money we are getting from our clients is not high enough to carry it by ourselves. And traditionally, that's a situation where the credit insurance comes into place, because the factor by himself transfers the risk of failure from the debtor account to the credit insurance company. And that brings in a fourth player into the game. And with the fourth players, apart from three players, there's more complexity behind it.
Yeah. And how do you deal with that complexity?
Dices. No, seriously, how do we deal with that? With it coming, having the credit insurance within our business model as a fourth player, we have to rely on the credit insurance, the trade credit insurer, because he gives us the security when the debtor fails, the insurer is paying. So that means on the other side, on the factor side, we are only buying a receivable, we are only financing a receivable when we have the cover from the insurance. And this is kind of a double-sided game. We first have to ask and make sure that we have the coverage. And then we go to the client and say, okay, we can buy your receivable against debtor A, B, C, D. And to coordinate that in a multi-level business where you are dealing with hundreds of clients, with thousands, hundreds of thousands of debtors every day, that makes it more complex than just dealing with three parties.
So, there is the angle of the complexity here in the triangular of the related parties, the factor, the client, and the debtor. So I think what is very important, if you maybe just shortly describe how the process flow is within the system and which role the monitoring plays in that game.
Very good question. The process, you have to understand that the factor doesn't rely only on the trade credit insurer. Of course, the insurer covers the most part of the debt, but each factor has its own risk management on the debtor side. So the first thing is that you get all the information about a debtor into the system. And these informations not only come from the trade insurer, but they also come from information agencies. They come from market sources. They come from the client himself. So you have a multi-information flow into your system, which has to be managed. And once you have all the information into the system, it just doesn't lie there, and you think, okay, I have information now, what do I do? The information must be capable to analyze this information and to structure it, and to come to, if possible, to an automated decision about the limit you want to sign and you want to give to your client to buy these receivables. And this analysis and this decision process, this has to be kind of automated due to the high figures and the high numbers of debtors and decisions you're taking. And then once you have made a decision, it's not the end of the game. Then it, from a risk perspective, it actually starts. We all know that our playing field, our area we are working in is not static. Things are changing. We have to see that, especially at the moment, that the world is changing very, very fast. So monitoring is a major part after your decision, because things are changing. The industry of your debtor changes, the industry of your client changes, your own industry is changing, the whole environment is changing. And you have to detect these changes, and you have to analyze these changes, and then see what do these changes do with your limit. And if it's on the good side, you can probably rise the limit, but from a risk perspective, you have to be very careful to follow the limit and see, probably you have to stop the limit, you have to lower it, you have to take measures to lower your risk as a factor. So monitoring is a key part of it in the running business. A decision is done very easily, you could dice it. But then seeing the change in the limit and the change in the environment, and to detect the kind of, I always say, tipping point where the risk changes from the good to the bad, that's the secret behind monitoring.
Yeah. Where do the information sit? Is that in one database? Is that in one single system? Maybe if you could describe that a bit.
Yeah. From a risk perspective, in an ideal world, this information is all sitting in one database. Because you have to have all information in one place, because you're working with this information. As I said, it's not static, it's changing, so you have to see where do your information come from, and you have to have them in one system, because you need one analysis, and you need, at the end of the day, one result. So you have to see, a credit insurance says that the debtor has a rating A, and the information agency says it's a C. So what do you do with that? They're contradicting information, you have to do something with it. And that you can only do if you have aggregated information, and you have information which are kind of summarized into a rating or a number or figure which you can work with.
Yeah, so when we are talking about data, it's the question how to get the data into the system via technical interfacing. So what is the role of the interfacing and the importance?
From a technical perspective, it's the central role, because through the interfaces all the information runs in. And you can't handle manually all these different information sources. We heard earlier on, I think from Marion, that we are working with social media information, market information, news information, and all different sources, and they have to come in to the system automatically via interfaces. And the interfaces is only half of the story. The next part of the story, and that's where CUM comes into place, it needs to be aggregated. It has to be analyzed and has to be aggregated to one format, so you can actually work with it. It doesn't help you if you have a PDF as one source and you have some data on the other side. It needs to be aggregated into one information, into one workable information on your side.
Yeah, so when we are talking about interfacing, database, data flows, so it's also a question regarding the automation of processes and decision making. What are your experiences with that?
The experience, the experience is that you need a kind of automated information inflow. So you don't have to care if any information on the source side of the information is changing. The source gives you the information, and the system has to recognize the different new information, has to analyze it, and then it comes to the credit manager, to the risk manager, and say, look, there's something has changed, the business model has changed, the big client has been lost, or any information about your debtor, to work with it.
So we talked about the credit risk. Maybe one side step, because when we are talking about automation, when we are talking about data and monitoring, maybe what about KYC? I'm taking this question in because when we are talking about the risk that we are facing at the moment, of course, coming from the compliance view, it's necessary to also have automated processes in the field of KYC. How do you do that?
When we're talking about KYC, we're kind of shifting the perspective a little bit to the client.
Yeah.
Luckily, within the regulation, we don't have regulatory-wise to look at the data side. That's mainly what the information agency and the credit insurer does for us. They identify the data. But now we are looking on the client, and from a regulatory perspective, but also from a compliance perspective from your company, you want to know who's your client. Who's your business partner? Know your customer, know your client.
Yeah.
And in an ideal world, in a high volume client business, you need a high amount of automatization behind it, which from a regulatory perspective is quite difficult because you don't have all the necessary information available in an automated way. So from the KYC perspective, today we are working in a kind of a mixed environment. We get some automated information. The system can analyze a lot of information. It can say, okay, who's the beneficial owner, who's the managing director, but all the information behind, kind of second and third level information, who's behind the company, who's behind the owner, what is the environment the company is working in. That has to be done at least from a client perspective more manually, because the information is not always available, and it's not always in the quality available the regulator expects from you.
Yeah.
And so there's still, we have kind of mixed processes, and we all hope that via digitalization, via the EU digitalization program, we can digitize these processes more and more, and more information get available on a digital way. But I think we are probably still 3 to 5 years away from that. So KYC is still difficult. It's a lot of manual work, a lot of manual analytics, and less system analytics.
Yeah. So, well, that sounds a little bit that when we are talking about handling master data, and now a technical expression here, to have all the master data in one single system for the credit risk on the one hand, the debtors and suppliers on the other hand, KYC data. So it seems that it's a single point of truth that you want to implement here.
Yes,
in that system.
Yeah. We have to, on a client side, on a KYC side, because there's only one truth, there's only one owner behind it. There can't be two if there's only one. So there's one truth. With the data, it's probably a little bit easier. But on the client side, we have to define the source of truth and say, okay, that's the truth for us, and all accordingly processes run on this truth.
Yeah, and there are lots of discussions at the moment in terms of ESG, and as soon as I have in one single database relevant business partners, and to evaluate business partners from a different angle, which is coming from the ESG. So I think there's a long way to go in that field, and in terms of data availability and systems availability to do that. So it's something which is ongoing. You cannot take that out of the shelf. Not yet. What is your wish, your expectation in that field?
More digital information and more time from the regulator to transfer and transition these processes into the new world. We just received the new minimum requirements for risk management yesterday from German regulator BaFin, with a lot of requirements, especially on the ESG side.
Yeah.
And ESG is a new dimension, something additional to the traditional credit management, where I look at balance sheet, a P&L, and blah, blah, blah. Now I have an additional dimension on environmental, social governance aspects.
Yeah.
I have to get data, which is the biggest problem at the moment, because most companies don't know these data by themselves. So how should I know them?
Yeah.
And there where information provider, information agencies come into place. And then the same game starts again. We have to collect all this different information into one database, have to analyze it, have to evaluate it, have put probably a rating behind it, and then say, okay, this client has a super balance sheet, but ESG side, he's more a triple C or almost a D. What do I do with that?
Yeah.
But information gathering is the main part of it, the main problem.
Yeah. So, well, things are changing in the coming years, and of course, what we see in the market, that there are also incoming players regarding software solutions to support that kind of business. What was important for you, or the main criteria to select a software provider? What is important from your perspective, and maybe also coming from your experience from the compliance side, because we are talking about regulated market.
Yeah.
So I think there are capabilities that are must-haves and cannot be questions at all.
I think looking from a user to the supplier of IT, in this very specific area, which is very much specialized, I think I expect the same specialization from my software supplier. So focusing on one central subject, risk management, compliance. And large software companies sometimes lack of this focus. But we need, as we are supervised by the banking regulator, by the auditors, we need very specific and very transparent IT systems which can support us in these functions. And therefore, the supplier must be kind of dedicated to regulatory, dedicated to risk management.
Yeah.
And that dedication we can import into our world, and then I'm quite happy.
Yeah. I think that's also allows that the specialization in the field of KYC, credit risk, etc., specialized solutions are in place in your company because it's very important in that market. Taking a different view, an international view maybe, we started with the non-recourse idea, and so there are maybe players in the market in the factoring not coming from that. Maybe it's not really the non-recourse business, rather than a different factoring services here. So what do you think? What is the starting point for them if they want to go into the non-recourse factoring?
I think basic is what I said in the beginning. To widen the triangle to a four-player game at the end. You have to take into consideration that you have to monitor, you have to analyze your debtors, and with the trade credit insurers, you have a fourth player in your processes, and you have to coordinate them. You have to install all these different processes with the credit insurance. And credit insurance by itself is a perfect product, but it's complicated. It's not easy, and you have to implement this complexity into your world to cover the debtor risk, because you can't do it yourself. And credit insurance is the instrument to mitigate the risk on one side, but then you need systems and processes on the other side to handle that.
Yeah. Maybe an idea. So what we see is there is a volatile environment, and it's necessary that you are capable to react on the environment. Yeah. So what is the role of self-servicing, so that you're able to do things on your own? What are your requirements and the benefits that you take out of that?
I'm very much excited about self-services because I think that's the way we have to go. In the kind of old IT world, I came to you and I said, oh, I want to have that field in green and that in blue. Can you do that? And you said, yeah, it costs 2,000 euros. And I say, okay, you do it. And half a year later, it's done. One field. And half a year later, it's done, you write
Yeah.
a bill, everything is fine. With self-services, we as a user, as a factoring institute, we are in a position where we can choose by ourselves if that field is green or if the formula to calculate a rating is that way or that way. And that gives us much more flexibility. It gives us much more speed in a very difficult market, in a very fast-changing market, also from the outside and from the inside, and from our clients. So we can react much quicker, we can react much more precisely, because with self-services I can create my own models, my own processes, much more precise based or necessary for my business and for my clients, rather than having a standard for all factoring institutes in Germany. So self-service, I think, is a brilliant way into the future, and I think one major criteria to select a supplier would be the capability to offer these self-services for my organization.
Yeah. Coming back to automation, automation has a certain purpose to support scaling the business. What are your experiences?
Automation is basis, is necessary, and it's a way to scalability. And so automation is absolutely necessary. From a risk perspective, automation is a little bit kind of versus risk management, because risk management relies very much on people and on experience, on information. So you have to find a good mix between fully automated processes and decisions where you say, okay, I have a credit analyst and he's much quicker, much better, and much deeper into the business than any machine. I know it can be viewed at differently. A lot of people say, okay, automation, automation, automation. But I think in a risk business, you still need people, you still need experience, and you have to find the right balance. There's economy against risk.
Thank you very much for this interview and the insights.
Thank you, Robert.
Thank you.